Okay, it's time to get the show on the road, folks. Want to welcome every one of you for taking the time to join us today. I know we have a lot of people who are new to earningsbeats.com. Want to welcome you. Also have a lot of people who've been with us a long time. Going back to our origin, we first started our business in 2004 and developed it into earningsbeats.com. Appreciate you taking the time to come in. During the afternoon on Saturday. I'm sure people have plenty of things to do, so we appreciate you taking the time to stop in and join us. Today's event, exploring the new StockCharts ChartList sharing feature with Earnings Encore. Tom Bowley going to be joining me in just a couple of minutes here to get into the meat of this thing. A few things he'll be covering today will be showing the old and new improved ways of sharing the Strong Earnings ChartList, a big enhancement. Discussing the strategy behind creating the Strong Earnings ChartList, beating EPS and earnings estimates, the benefits of being both an earningsbeats.com and StockCharts.com member, how earningsbeats.com members get daily access to high reward to risk trading candidates, the strategy behind our portfolio selection process, evaluating results from Q4 earnings webinar that was hosted on January 27th, and a biggie here, fresh list of earnings-related candidates to consider for next week. So you can see there's a lot of stuff to be covered here. So this is going to be going on a while. I can tell you that. The good news is it's being recorded. If for some reason you got to slip out or you're unable to stay for the entire event, you don't have to worry about that at all. You will get a copy of the recording. So you don't have to worry about missing anything. If for any reason you run into a technical problem, feel free to send us you can go to our website, send us a notice, and we'll try to help you out. The good news, is all this incredible technology now, especially the cloud recording, gives us an opportunity to make sure that the recordings are crystal clear, even if there's an issue during the event itself, which happens when you have a lot of people in an event like we do today. A lot of seats filled here. Okay, so that's sort of what I wanted to get into. I wanted to share a couple of quick things with you for another minute or two, and then Tom's going to come in. So give me just a second here. I'm going to share, because we have a lot of new people here. There we go. If you're not currently an Earnings Beats member, I want to let you know that we have a special. If you go to our website and go right to where it says our service here, and you click on that link, it takes you right to this page, and you'll be able to sign up for a 30-day trial at no cost. There's a standard charge of $7 for 30-day trial, but you'll be refunded that. So you end up really with 30 days of giving us a shot for nothing. It can't really get any better than that. The importance of this is in addition to getting everything you see on here, going to get you access to some things that are going on today, and in particular, the list of stocks that Tom's going to be going over later today, as well as one of the biggies, one of our biggest events is our top 10 stock pick webinar. That next one is going to be coming up on February 19th. And it will be during that event that Tom will unveil his top 10 stock picks in 4 different categories. So 46 stocks in all. Very popular event. And if you become a trial member, now you get access to that event. So really worth considering joining for the 30 days to get a feel for who we're all about. Now, in addition to that, we always have a webinar special. If you go to our website, check on webinar special. This is for people who want to join us for a full year. You just save a lot of money. The details are here. You get a bonus month. You get 13 months, and it'll give you 4 quarters of working with us, and that's a really good time for people to work with us during a full year. So much happens during the course of the year. We have so many events, including the top 10 pick webinar I mentioned, Tom's daily market report. I want to just briefly mention the relative strength industry group chart list. That's only available to our annual members. Tom identified all 104 industry groups, and we make that available to our annual members. Once you get the list, you have it forever, and it's updates on a real-time basis. It allows you to zero in as a trader on the strong and weak industries, so you can look at long and short potential trading candidates. It's especially great to add along with our strong earnings chart list. We have 129 stocks right now that have beat earnings expectations, top and bottom line. Tom will go over that a little bit more in a minute. And we update that on a regular basis. Very powerful to have that along with the relative industry group chart list. Anyways, this is everything you get, for the special price. You save a lot of money. You might want to consider it. Minimally, if you're not a member, sign up for that no cost 30-day trial. I guarantee it'll be well worth it. Okay, on that note, I'm going to really step out now and turn it over to Tom, because really that's what you're here for, is to hear everything he has to talk about. And then I'll stop in a little bit later. Tom will just take a break for a glass of water, can answer any questions about membership, etc. So without further ado, let's bring in Tom Bowley.
All right, thank you, John. I'm really excited to do this webinar today. When I was talking to Grayson Rose from over at StockCharts, and you get a lot of information from Grayson in the chart watchers. He usually has a blurb in there, and they're announcing a new feature today. You definitely want to check that out if you haven't already seen it. But one of the things that we've been working with Grayson on for a while at Earnings Beats is being able to share chart lists. Our service, I think, is really unique in that we have a lot of fundamental information. For those of you who aren't aware, I passed the CPA exam in 1984. I was in public accounting for 20 years. So the fundamentals are still near and dear to my heart, but I have a passion for technical analysis. So marrying the two together, I think, gives me a little bit of an edge, or at least a unique approach to the market. And so anyhow, when I went back to Earnings Beats in September of last year, I'd been senior technical analyst over at StockCharts, as many of you probably know, for 4.5 years. But prior to that, John and I worked together. We started off together at Invested Central, and then we changed the name to Earnings Beats because it just was much more appropriate with the type of work that we were doing. I think we changed it back in 2013 and have been operating as Earnings Beats since then. But in September of this past year, I ended up going back, and it's been a really exciting time because our business has just evolved so much in terms of what we do, the education we provide, and I honestly think it's unmatched in the industry. We've gotten a lot of emails, I think, that would agree with that. But Grayson, one of the things I talked to him about was, we really struggle with sending our chart lists that we keep to our members. We like our members to have what we have, especially if you're a StockCharts member at the extra level or above, and you're also an Earnings Beats member. It just seems like I should be able to get the information that I use at StockCharts to our members much more easily than we used to be able to do. And so I'm going to start off here. I'm going to show you that. I'm going to get into it in just a minute. But before I do, I've already had some emails asking what the heck happened to the stock market this week. And so I want to make sure that, I go over some of that as well, just to answer a couple of questions. I don't want this to turn into an analysis of the stock market. webinar, because that's not what this was designed to be. But I understand with the market turning down the way it did on Friday, how everyone still, is maybe a little bit more nervous about what's taking place. What I will say is this: if you go back to an article I wrote in Chart Watchers 2 weeks ago, I said the masses were growing too bullish. I smell a short-term top. And I went in and I showed the S&P had gone straight up since breaking out of this ascending triangle. It had made its measurement. The initial measurement was only 32.25. It went to 33.25. So it actually went a little bit more than the measurement. And what I saw was, and this was just one thing I laid out in Chart Watchers, we did an impromptu webinar for Earnings Beats members. It was that important that we just created a webinar out of the blue because I wanted to communicate some things that were going on. But here you can see the equity only put call ratio. This goes back 15 years, and we were reaching bullish readings. Anytime that equity only put call ratio, when you see the equity only put call ratio going down to these lows, it means that fewer puts are being bought relative to calls. So in other words, a lot more calls, a lot less puts. And when everybody starts getting really bullish, that's when you start jumping into all these calls. And you can see throughout 2018 and 2019, when our trade war and the Fed was messing up and everything else, the market was very nervous. And so we never had complacent readings like this. But look at where we were at the beginning of 2018 on this reading. And that was what created a major top in the market. We got too complacent. Look at where we just went to. This was the 17th of January. There's the date right up here, January 17th. So we had reached levels that we had not seen in quite some time. And when you look back to what happens to the market when you get these kinds of readings, you can see that the market, it's not like the market goes into a bear market, but it needs to pause. The market has just gotten too far ahead of itself. Everybody believes the market's going to keep going up, and that's when you run into trouble. And so earlier today, I was writing, and I did a Don't Ignore This Chart, which I do every once in a while. I write in that blog. And I'll tell you, the last 2 days, I have seen so many articles that say the stock market's going down because of the coronavirus. And I don't want to downplay a virus. I mean, obviously, from a health perspective, it's an emergency. I think, countries around the world are taking precautions. They're doing the things they're supposed to do. I'm not saying that this isn't a health emergency. I'm not saying it's not a big deal. Obviously, it is. But the media likes to just grab a hold of something and say, this is why we're going down. And I talked about 2 weeks ago the fact the market was topping. It needed to pull back. And so in this article, if you have time, if you didn't get a chance to read this earlier, you might want to go through there. It's my opinion. If you don't agree with me, that's fine. I don't have any problems with that. But I went through and I highlighted this impromptu webinar that I had done back in mid-January. And you can see the items that I went over in this. I actually went back and listened to the webinar yesterday because I'm crazy and I don't have anything else to do with my life. But who else does this on a Friday night, right? But if you look at this, these were the things I talked about. The equity only put call ratio. Earnings Beats members, and maybe some of you that follow me in my blogs know that when the market is going up, the VIX usually goes down. When you see the market going up and the VIX going up with it, that is usually a sign that the market is, why would it be getting more nervous as it gets higher? Usually it's the opposite. So when you get increasing volatility with the S&P moving up, that's when you want to be really cautious. And so we were seeing that. So equity only put call, that's a sentiment reading telling us things are too bullish. Then you got another sentiment reading, the volatility index, which was starting to move up. So that was the second thing. The third thing, 1 month leadership from defensive groups. If you looked in mid-January and you looked at the last month, normally when the stock market's going up, you got technology leading, consumer discretionary, communication services, financials, industrials, those aggressive groups. Well, in mid-January, when I pulled up the 1 month leaders, it was utilities and real estate. So that was telling us money was rotating more into defense. Then we get into the end. We basically were coming up on the end of the most bullish historical period of the year. I do a lot of historical work looking at the market. And I have a spreadsheet that goes back to 1950 on the S&P 500, every day's close since 1950. And what I can tell you is that the market is twice as bullish from October 27th, right here, October 27th to January 18th, the market is twice as bullish as it is throughout the year. Average annual return since 1950 is 9%. If you just look at the annualization of the returns on this period, it's over 20%. So January 18th was approaching. So now we're getting ready to head into the, not a bearish historical period. Bearish historical period starts in about July, but it's going into a period that's not as strong. We had negative divergences on hourly charts, daily charts, across not only the major indices, but also some of the key sectors, technology and so forth. We were obviously overbought. I think everybody would agree with that. And then there was a breakout in treasury prices, which is another defensive area of the market, and a corresponding breakdown in the treasury yields. All of this was coming together simultaneously. Now, maybe the market ignores one or two or three of these, but to have 7 of these different things line up all simultaneously told me it wasn't worth the risk, that we should be talking about, cutting back or, whatever it means to be more cautious. Some might just sell and move to cash. I've had a number of emails where some did do that, and now they're looking to get back in. Some, might sell calls. You can do a covered call strategy. You can sell calls against positions you own. You could just buy insurance puts on the S&P, whatever it is to protect. That's what we were suggesting. And then, so now we finally get this pullback, and now all of a sudden it's because of the coronavirus. And I was just being a little sarcastic here in the article, but it's way too early to tell whether or not the market's going to be impacted by the coronavirus. Now, there are some areas that definitely are being impacted. Airlines, I mean, when you start canceling flights into China, you're giving away revenue. So yes, there are definitely areas of the market that are being impacted by this. But to just make a blanket statement that the Dow Jones is down 600 points because of the coronavirus, or that, the selling every day. I remember, I think it was back on Wednesday of this week, after I saw headlines earlier in the week talking about the coronavirus was sending the market lower. I think it was Tuesday or Wednesday when the market bounced back to the upside. The headline was, the coronavirus fears aren't as bad as we first expected. And I'm like, really? It's that just changed like that overnight, and now all of a sudden it's bad again? It's the media, and the media is going to overhype anything they can because they want clicks. What scares the heck out of people? Well, a virus spreading across continents will do it. And so they take advantage of that to try to get more viewers. If they get more viewers, they can sell more ads, and the ads are more expensive. That's the game that the media plays. They've got to get eyeballs. So anyhow, I went on a little bit of a rant there, but the more important thing is that technically, historically, there were a lot of reasons why the market needed a pullback, and we've started it. How far we go? Well, I wrote about that a little bit too, and that was in Trading Places. I've been writing a lot. So in addition to reading or going back and listening to old webinars, I've also been doing a lot of writing here the last 24 hours. But earlier today, it was just a couple hours ago, I wrote key levels to watch on the S&P 500. So again, I don't want to spend a lot of time on this, but the short-term 3 to 4 month run that we've been in, I think ended. That doesn't mean that I think we're going to crash, but I think that this big push to the upside now is confirming that we are in a consolidation phase. How far this goes down, I was looking at Fibonacci to give us some ideas. First level would probably be another 70 points on the S&P if we get down there. I believe it'll be somewhere. I don't think we're done with the selling just yet, especially with the VIX rising. I think it'll be somewhere between 3150 and I'm going to say 3025, which was this breakout level. I think I showed that. Oops, that's not what I wanted to do. I think I showed that here in this. Yeah. So down here is the line where we broke out above 3025. So that almost coincides with a 61.8% Fibonacci retracement. So I don't know. I think it's going to be somewhere in this 100, 125 point range. That's what I would be looking for. If you're on the sidelines, I don't know that it goes down that far. I would be thinking about getting in incrementally. Remember, we're in a zero trading commission environment now. So it doesn't matter. It used to be, well, there's no point in buying every 10 cents on a stock or every 50 cents because the commission would eat that up. Well, not anymore. So literally, if you got a $20 stock, you could put in a buy order every 10 cents to fill out your position. And that's what I would do. I'd take advantage of it. So anyway, that's all I wanted to talk about, just real quick. I was getting a lot of emails and questions, and so I thought I would just kind of go through all of that. But it's just my opinion, but I think in a month, 2 months from now, the coronavirus, we're not going to be hearing anything about it, just like we're not hearing anything about the trade war anymore. That was 2019 story, maybe 2018 story. That's over. It wasn't even the trade war, in my opinion. Again, it had an impact on some areas, but in my opinion, it was much more about the Fed than it was, the Fed all of a sudden now is very accommodative. Beginning of 2019, late 2018, they were very hawkish. And that was an about face for the Fed in 2019. And so to me, it was more about the Fed not recognizing some of these things and not becoming more accommodative earlier in the process that led to a lot of that volatility we saw in 2019. 2020, now it's the coronavirus. But in my opinion, again, just my opinion, I think we are going to explode to the upside. I think we already have. I think we've started a major secular bull market advance. We're getting a little bit of a correction now, but I think we will return to it. And I still am holding to, I think the S&P 500 is going to hit 4,000 this year. And I know I'm one of the more bullish people out there, but I also, again, will fall back on my fundamental background. And I valued companies. I know how you value companies. And you take future earnings and you discount those earnings back based on current interest rates. And if you've got future earnings growth, when you look at companies like Apple and Tesla, the Tesla report was unbelievable. How about Amazon, the blowout that they just had? I mean, when you get those kinds of beats on earnings and then you have to adjust your forecast going forward and your earnings start moving a lot higher and you're discounting those back at 1 point whatever percent, those earnings are extremely valuable. And I don't even remember, I wrote somewhere, one of the articles I wrote, I talked about this being an environment that I've never seen in my lifetime. And that, I'm not being dramatic. I'd never have seen an environment where we've got moderate growth, extremely low interest rates, historically low interest rates, and because inflation's below target levels, you've got a Fed that is not going to be hawkish. Even if earnings continue going up and the stock market keeps going up, we're not going to have a hawkish Fed. They're going to keep rates low. So all of this earnings growth is just going to multiply. And I just chuckle when I see anybody talking about, again, just my opinion, but when I see someone talking about PE ratios being too high based on history, I just think to myself, well, this isn't based on history. I've never seen an environment like this. So anyway, that's my spiel and shtick, and I'm going to go ahead and go with it for now. So let's start off here. Again, I talked about Grayson over at StockCharts, and they were able to work with us and get us something that I think is just fantastic. So let me show you what we had to do before. For every member of Earnings Beats who also was a member of StockCharts, this is what we would do. Here's what my Strong Earnings chart list, right? Okay, so I got the Strong Earnings chart list. In here in the edit, there's a send to friend. So every one of our members, we'd have to keep track of their user ID over at StockCharts. They'd have to send it to us. And we would go in here and we would type these in one by one to all of our members. So if you've been getting the StockCharts or the Strong Earnings chart list for the last several months, and you've been getting it sent to you individually, you should thank Erin Weber, who happens to be my daughter, who has had to individually send these out every time we adjust the Strong Earnings chart list. And that gets adjusted, as you know, every week to 2 weeks, especially when earnings season kicks in like it is now, because we're constantly adding more and more companies to it. So we have to keep sending it out. So that was a manual process that we had to go through, and that was really frustrating. So what is different now? Well, what StockCharts has allowed us to do, they have a shared chart list feature. And so I can take a link to my chart list and I can send it out in, say, the daily market report, which goes out to all of our members, and it's just one link that all of our members get at the same time, basically. And what you would see is something like this. So let's just say this is in my email. I sent it to me so you could see it. And so let's see, here's the strong earnings chart list. Here are the earnings predictions, bullish and bearish, which I'll go over a little bit later in the webinar. But for the strong earnings chart list, what I would do, it comes to me in an email. This is what I do now. I click on it and I save to a chart list. Now, I already have a strong earnings chart list. So when we update people, when we update all of our members with our strong earnings chart list, if you've already downloaded it, you've got it somewhere in your own account, your own chart list. So what you can do when you get it, first of all, make sure that this include chart styles is in here, because otherwise it'll probably, I don't even know what it does. If that's not checked, it'll probably just come in as your default chart style. Everything will be set up in your default style. But if you click this, it means it's going to come through in my chart style, which you'll see throughout this webinar how that looks if you're not a member already. But look at this replace list. So I can go in here. As soon as I get the link, I click on it. I come up here. This just took 1 second. Replace list, and I go down and I find my strong earnings chart list, and I click save results. And there it is, successfully saved. How long did that take? If I, all of a sudden make 100, put 100 new accounts in, I might spend, I can't even tell you how many hours I spend going through earnings reports, finding the ones that beat top and bottom line, going through, annotating the charts, evaluating the charts, saving them in my chart list, and literally I hand them to you on a platter, just like that. Every time I update, all you're going to see is a link, and you're going to come in, you're going to replace list, and it's going to be up to date. All the work's done for you. I think that's pretty cool. Now, what happens? I'm going to sign out of this account. And now I'm going to click on the link. So now I've got the link. Let's say you're not a member at StockCharts. You can still get this link. I'll show you what happens. So now I click on it, and now it's telling me to save the chart list. But if I try that, I'm not signed in. So either I'm a member and I just haven't signed into my account, or I'm not a member. If I'm not a member, then you're going to start getting all these pop-ups for a free trial. You're going to get ads on here that you probably maybe don't want to see. Obviously it's taking up a lot of space on your computer. But as you go down here, you can click on one of these charts. So I'm not signed in. So if you're a non-member, you can still get all of these charts. Here's one, here's another one. I can tell you that at our high, we had 380 charts on here. So you can imagine going through these one at a time. It's not that it's a bad thing. It's just going to take a lot of time. If you're a StockCharts member, so let me get back out of here again. Well, actually, let me pull up one of these charts. So let's say you're not a member, and you want to just click on one of these charts. You can click on each individual chart. It'll bring it up, but it brings it up, and look at all the ads all over the place here. So that's what you're going to see. You're going to see ads. You notice there's no place for me to put it into a chart list because I don't have an account. So there are no chart lists. You can't save them. So that's the problem. I mean, you might see something and you're like, wow, now what do I do? I guess maybe take a bunch of notes in a notepad. I think you can see how the organization and the time savings, it's worth getting a membership. And if you don't have one at StockCharts, it's free, 30 days free. And the membership that John explained with us, if you're not a member, you get a 30-day trial, you pay $7. It's going to show up on your credit card. We're going to refund you the $7. So for 30 days, you're not going to pay anything for either one of these services. And it is amazing the kind of information that you can get here. So, all right, so let me go back here now. Let's get out of this. And let me go back in. Let's sign back in here. All right, so now I'm back in. So again, I just get that, I grab it, I just put it in. Now let's say, and I'll show you these, I'm gonna go over all these earnings predictions a little bit later. But let's say, I wanna download this first bullish prediction. So I can go to a chart list. Now, this is a new file. I've never saved this before. So this one is not going to be something that overwrites a prior list unless you just have an old list and you don't care, in which case you might want to make sure you change the name or you're not going to know what's in that folder. But here, I'm just going to go ahead and say, I already saved it once, but I'm going to show you how you can do a new one. So you just have to figure out however you want to title it. I like to keep things, I like to have numbers in front because they get sorted based on number and not alphabetically. And then I can kind of have a kind of a format, an organized format of where I like to find these different chart lists. So I'm just going to put it in here. I've got my new chart list name. So I had to spend a couple extra seconds there. But now I'm going to save the results. It's saved. Boom, just like that. How long was that? I mean, I had to think what number I wanted to put in front of the chart list. So all the work that I just did, and I think there's like 50 charts that are going to be reporting earnings this coming week. And now they've just gotten saved into this count. All right, so now I could go in and I can pull this chart up and you can see this is one that's been doing very well. Look at the relative strength, all moving up. So this is a stock I like. Again, I'm not going to really get into that now. But if I go into that 0430 account or chart list, now I can view all. I can do a summary, and there they all are, all of them right in there. I can run scans against the chart list. I mean, there's all kinds of things I can do. So anyhow, but I'll get into all that in a little bit. I just wanted to show you how much easier this feature is now. I literally can send out to all of our members on Monday. What I'm going to do is send out this Strong Earnings chart list to everybody. So if you're in here today, even if you've never been involved with earnings beats before, what we're going to do is we're going to send this chart list out on Monday morning to our Earnings Beats Digest subscribers. And so if you're an Earnings Beats Digest subscriber, if you're not an Earnings Beats Digest subscriber and you're in here, we will make sure you get set up and you'll get the copy of this Strong Earnings chart list. Now, the bullish and the bearish, and I'll talk about this a little bit more, we're going to go over all the charts. But if you want the chart list sent to you, just do me a favor and sign up for a $7 trial. Get your $7 back. And so I'll send a number of chart lists to you that I'll talk about a little bit later as we go through the webinar. But this is all great information I think will help with your trading. It'll give you a much better sense of how we approach earnings season with the Strong Earnings chart list and so forth, and with these predictions on earnings. And I'll go over the predictions more in just a little bit. So here's the idea with the Strong Earnings chart list. And again, it really combines my background fundamentally and technically in that it's always important. It was always important when I was in public accounting to trust management. From an accounting perspective, from an auditing perspective, it was important for obviously our liability purposes as an auditor. You don't want to go in and just take somebody's, oh, the books are fine, great, we're going to leave now. No, you don't do that. You evaluate management. So from my perspective, it was always important to evaluate management's integrity, to help evaluate the reliability, the number of tests that we're going to perform in an audit, what kinds of tests we're going to perform. So one of the first things I would do, especially if it was a new client, is to meet with management to find out, get my comfort factor on exactly how I wanted to set up audit tests. That's what I did. I audited companies, including banks and some others. Wall Street, I think, does something very similar. Wall Street, though, is looking to invest in these companies, but they still need the integrity. They want the integrity of management. I mean, it doesn't do Wall Street any good. And in fact, it really hurts them in their pocketbooks if they go out to a management team and management says, oh, wow, we're having a great quarter. We're looking to blow away these estimates. Wall Street's expecting $2. We think it's going to be $2.20 per share this quarter. And then you come out with $1.90. Well, Wall Street takes you at your word. And they go back, analysts go back, they're buying for their own accounts, they're buying for their clients' accounts based on the information that management provides them. Now, what do you think Wall Street thinks of that management team when they just got done telling them that they're going to have this great quarter, and then everything falls short. And you've got to be, I mean, I've never been in one of these meetings, but I've got to be kind of like I would have been as an auditor. I would be saying, what the heck's wrong with you people? Why did you tell me this? I went out and, analysts are going back to their firms. They're buying your shares based on what you're saying, and none of it's true. Now, I might be over dramatizing this a little bit, but I think that Wall Street has a problem with management teams that don't follow through on their promises. And that's what these earnings reports are. They're basically saying, did management teams provide you information that was conservative? In other words, were they under-promising and over-delivering, or were they over-promising and under-delivering? And I think that that's important, not just for Wall Street, but it's important for us. And we need to know, heading into earnings, whether or not these companies are truthful, whether they're honest, whether they've got integrity. And we can do that by looking at their track record. And we also can get a general sense if they're telling the truth to Wall Street, and Wall Street's acting on that information, which I would suspect they would, we should be able to tell by the price action. If you've got two companies, say Applied Materials and KLA Corp, they're both semi-equipment manufacturers. Well, if one of them is going up relative to the group and the other one's going down relative to the group, to me that seems to make sense that the one that's going up is the one that's more likely to come out with a report that's better than expected. And that's the whole idea behind some of the predictions that I'll go over in a bit. But as far as the Strong Earnings chart list, I only want to trade those companies I can trust. And so, or management teams I can trust at those companies. So that's why we have the Strong Earnings chart list to begin with. I don't care, you can promise the world, but if you can't beat it or if you can't match it, beat it, really. I want conservatism in management. I want them not only be growing their earnings, but I want them to be conservative. If you think back to what Apple has done over the last 20 years, they have underpromised and over-delivered almost every quarter. I mean, not only do they have great products and their sales are booming, but they also have conservative management teams that you can trust. You hear about earnings whispers and things like that. Well, when you have a company where management tends to underpromise and over-deliver, then that's when you get into these earnings whispers where you're like, hey, they say they're going to do $2.50, but I think they're going to do $2.75 based on history. And that is what gets the attention heading into earnings. And that's where you get a lot of these companies that get bid up into earnings. So it's just important to understand how Wall Street works. So getting back to that and the whole SECL, Strong Earnings Chart List, I want to just show you, like at Zacks, what I do to go through. And I'm going to go into the earnings releases. And let's just go back. I'll pick a day where there's not a lot of earnings reports. So let's go back to January. And I don't know, maybe the 21st, probably the banks were reporting. And you can see here, these are all the reports. There are 51 of them out that day. And here they all are. Now, what I'm most interested in is which ones beat sales. So positive sales surprise. So I'll put these in alphabetical order. And then I'll just take a look at them. And I note on a spreadsheet, an Excel spreadsheet, I note which ones beat. And then after I do that, I go through and I look at the earnings surprise, put it in alphabetical order, and compare. And if one beat on the revenues but doesn't beat here, I take them off. If they've beaten on both, they're going to then go to the next step, which is where I look at the charts. Now, that was January 21st. Now, let's go back to February, and let's take a look at where we are, say, this week, February 5th, Wednesday. And actually, let's go back to last week. Probably last Thursday might have been a good day. Thursday the 30th. And so here are all the companies. There are 163 on January the 30th. So imagine going through all of these again, going through the positive sales surprises. And so there are about almost 50 of them there. And then I got to compare and look at the earnings. I go through all of earnings season doing this and then looking at the chart. So once I get the big long list each day, then I go and I begin to look at the chart. So let's see here. Amazon Here's Amazon just came out. They blew away their top line. And when you look at the bottom line, I mean, it was crazy. 647 versus 398. You want to know why they gapped up 200 points? That kind of earnings growth. All of a sudden, all their projections, you know, all analysts that are looking at 398 and basing their projections off of 398 now have to base their projections off of 647. And so, yeah, valuations are going to go up. They're not going to go up in one day. I have a feeling Amazon is probably going to be a big leader going forward now based on all of a sudden this huge earnings growth. But doesn't mean maybe we want to buy it today. We might get better opportunities here over the next couple of weeks, especially if the market continues to weaken. But Amazon will now be on my strong earnings chart list. So it's like a big watch list, a huge watch list. But the difference is I know every single company on there beat top and bottom line, every single one of them. And if I look at their industry groups, and John mentioned the industry group relative strength, let me show you this. So this is any of our annual members we send out this to. And we don't want somebody taking a trial 30 days for free and walking away with this, because this is something that can help you for the rest of your trading days and for the rest of your membership at StockCharts. Let me just show you what this is. So here's the relative strength industry chart list. So here are all the charts, as John mentioned, 104 of them. And I can view all of them and put them in summary form, sort it by percentage change. And this tells me that on Friday, yesterday, Broadline Retail was the best performing industry group relative to the S&P. These are all set up relative to the S&P 500. And you can see how much it beat the S&P 500. It was a huge day for Broadline Retail. Gee, I wonder why. Amazon reported. I mean, I know Amazon has a big impact on the broadline retailers. And so with that huge up day, with the market getting killed, that's why we saw such massive outperformance. Personal products also had a pretty nice day relative. And you can go right down the list so I can quickly see automobiles. I don't know if you've watched Tesla lately, but that's been crazy. And I can go right down and say, okay, these are the groups that beat yesterday. But, you know, one day, you know, anything can beat one day. Amazon had a good report. Broadline Retail hadn't been that strong, and all of a sudden it has a big day because of one news event. Well, what about if I go over here and I say, give me the 1 month? What's been leading over the last month? Automobiles. Tesla. Hello. Tesla's been on fire. And I think it was Tesla. Let me, was it, that's Chart Watchers. Trading Places. Where was the other one? I had the other. Don't ignore this chart. I want to go back there, and I'm going to go in the archives. I think it was right at the end of December. No, maybe not. Let's go to January. Maybe I didn't write it in here. Sorry, I'm getting off track here for just a minute. Maybe it was Trading Places. I could have sworn it was right at the end of December. Well, only one to check now is Chart Watchers. Maybe it was Chart Watchers I wrote it. There it is. Okay, so it was in Chart Watchers. So December 20th, I wrote about a stock breaking out with 21% of its float short. If you're familiar at all with a short squeeze, which is basically when a stock breaks out and you're holding it short, the thing is, when you own a stock, you know how much you can lose. It's whatever you invested. Your stock can't go below zero, and chances are it's not going to zero. So you have a finite amount you can lose. When you're short and a stock breaks out, you've got to cover that short. So basically what you've done is you've sold borrowed shares. You've got to buy the stock at some point so that you can return the shares. Well, when you get a stock that's making a major breakout and it's got 21% of its outstanding float short, that is 21% that is really going to start to feel a pinch as the stock keeps moving higher. The stock, Tesla. So here it was back in December, it was 410. And I know, you look at a chart like this, you say, well, I don't want to buy a stock when it's 410. I don't want to wait and get a pullback. I mean, I would be saying the same thing, to be quite honest. Well, Tesla, because of their earnings growth that Wall Street knew was coming, and this short squeeze, this has been a rise for the ages here in Tesla. Yesterday, with the market down, Dow down 600, Tesla went up another 1.5%, another $9. And I said before, I don't know if this stock gets a pullback before it hits 1,000. I mean, it's just, look at the volume. You've got short sellers covering. You've got massive earnings growth, which, as I said earlier, in a low interest rate, not low, in a historically low interest rate environment, with the Fed sitting on the sidelines, possibly even thinking about lowering again because inflation is below target levels, in a moderate growth environment where Tesla is exploding in its earnings, this is the type of action you get. All right, I did go on a tangent there. But the whole idea is that we send our members the Strong Earnings chart list, and then we have a daily market report that goes out every day. And I just pulled up December 3rd. This was back when the market had pulled back a little bit. And so this is another feature of our service that we send out every day that the market's open. And it's our daily market report, the EB daily market report. It normally goes out somewhere around noon, 1 o'clock. This was 11:47 when I received it in my account. I say maybe as early as 11 a.m. and I try to have it out by 1. Occasionally it'll be a little later than that depending on my schedule that day, but I try to get it out sometime between 11 and 1. And here you can see market outlook, the VIX surging. I mean, if we go back and we look at the S&P 500, this was on December 3rd. So on December 3rd, right here, the stock market was pulling back. You can see this move down to start the month of, the 9th was a Monday, so the 2nd was a Monday right there. So this was the gap down below the 20-day moving average. So up until this past week, this was the only quote-unquote weakness that we had in the last 3 or 4 months. And so that particular day, I was looking at the VIX, and I saw the VIX spiking. And I just mentioned that the VIX, don't expect it to go back to where it was in 2007, 2009, or even, I wouldn't even look for it to go back to the lows that we saw, or the highs in the VIX that we saw that were associated with the 2018, 2019 lows, because those were part of a long-term consolidation, which I don't think we're in anymore. We broke out above 3,025, and now we'll pull back, but I think they're going to be quick corrections, and then we move higher. That's what I'm looking for. So one of the things I mentioned in this particular report was that, I said, don't expect the VIX to hit highs experienced during secular bear markets, and not even to the level that we saw during the 2018-2019 bull market consolidation phase. I said today's high near 18 might be it. And sure enough, that's when we saw the move right back up. Now, this has been going on for a while. We need a little bit more than this. This was just a quick little pullback, and now we've got an ABC correction. This is going to be a little bit deeper, in my opinion, than what we had there. Although, whether, if it turns at 3,200 or if it turns at 3,025, I don't know for sure. That's why I'd be using any weakness maybe to begin building positions in strong stocks that show strong relative strength in strong areas. Semiconductors, software stocks, computer hardware, specialty finance, home builders. There's a lot of really good areas of the market right now, but that's what we should be kind of focusing on. Let's see. So back to that daily market report. So I go through that. Then I have a sector industry focus. And so I talked a little bit about seasonality in this particular one, but normally there's something I'll focus on there. And then get down to this strong earnings chart list. Now, this is what I send everybody. Well, what I do is every day in the DMR, I try to run some sort of scan against it. And a lot of times I'll even post the scan that I run so you can see how to create that scan for yourself in your, in your account if you want to run it, throughout the day or whenever. In this case, I was just saying that I ran a scan using unusually heavy volume. So I was looking for stocks on the strong earnings chart list that had unusually heavy volume. So 12, in this case, back then there were 325 stocks on the list, by the way. 12 of the 325 stocks had traded more than 50% of their normal volume as of 11 o'clock in the morning. So that's roughly the first 1/3 of the trading day in terms of volume, and yet they've already traded more than 50%. So they've got high volume. So it makes sense to take a look to see maybe what's going on with them. And you can see these are getting close to, this one's getting close to support. I think it ended up breaking down after that. So if you got in near support, you could get out pretty quickly. AYX was starting to strengthen. By the way, AYX right now is like $140 or $145 a share. It's getting close to breaking out. I think we have a long-term cup that has formed on the right side now. But this was one that I mentioned 2 months ago when the stock was 105. Let's see. ELF, this one's pretty much right where it was. I think this one's gone sideways since then. NMIH, I think, made a move, but hold on. So that was NMIH. It was at 31.97 on December 3rd. NMIH. So right here, December 3rd. Look at that move. Next 2 weeks, stock went up 35 and change. And when you look at the relative strength, I'm sure this one was pretty strong. So it's in the mortgage finance area. Yep, it had broken to a new 50. Well, it was near a 52-week high in early December, but it broke to it here with this push to the upside. And you can see relative to the S&P, it was performing well. Volume trends were great on this push to the upside, and it was testing gap support. So that's the whole idea. I like to put these stocks. Here was probably the earnings where it broke out, and that's when we added it to the SECL, Strong Earnings Chart List. But I don't like to chase. So instead, here it is 2 weeks later. I run a scan, I see it, and I post it, send it out to members. It's coming down, testing support. And now all of a sudden, I'm sure that the RSI, if I just go to a regular chart, had probably come down some. Yeah, I mean, RSI, which was up in the 70s, got close to 80. At that time, on that pullback, came down to almost 50. 40 to 50 tends to be a great time to get into a stock during an uptrend, which, by the way, you can kind of see here, it got down to 40 and close to support, and it bounced again. So that's the whole idea, is to keep this strong earnings chart list. We know the fundamentals are good, and then we're waiting on technicals to line up. And there were some others, but we want to keep going here. Let's check my time. Yeah, it's been almost an hour. By the way, if anyone needs to leave for whatever reason, this is being recorded, and we'll make sure everybody gets a copy. We'll send it out to our community. All of our paying members will get it, and all of our Earnings Beats Digest free subscribers will get it as well. So don't worry about it. If you have to go, you can always come back and check this out. We're going to go for another hour. And again, I know my Fridays spent watching webinars, my Saturdays writing articles and doing webinars. I need a hobby. Actually, I have a hobby. It's golf, but wintertime gives me more time to do other things. All right, so that gives you a little bit of idea about our strategy and what we're trying to do with this daily market report, what we're trying to do with the strong earnings chart list. And again, all of the work is done for our members. I can't stress that enough. I've gotten so many emails from people that are trading just off of this list now, and they love it, and with the market guidance and so forth. So again, give us a try if you're not already a member. One last thing before I get into these earnings predictions, I want to talk just a minute about the portfolios that we do. It's another part of our service that I think is pretty big. So I'm going to go into Earnings Beats. And I'll show you. So over here, you'll see portfolios. And this is the performance of each of our portfolios since inception relative to the S&P 500. Now, each one of these portfolios, we change the stocks in these portfolios once a quarter. And they're based on strong earnings. Every one of the stocks that go in these portfolios come off of our strong earnings chart list. Every single one, no exceptions. So it's not like I'm just going to go find some other stocks that you're not aware of. They're going to be the very best, in my opinion, the very best of the stocks that are on the strong earnings chart list. And you can see the model portfolio, for instance, which has now been we're in our 5th quarter now. Annualized, or not annualized return, actual cumulative return since November 19th, up 49%. The S&P's up 19%. So very strong outperformance, sticking with relative strength. And these next two, aggressive and income, both are outperforming the S&P 500. And the aggressive only looks like, it's up a little bit more than 1% above the S&P. This one's the most impressive of all of them, in my opinion. And I've passed this along to members. But if you take a look, first of all, the aggressive portfolio is going to be made up of small cap stocks and mid cap stocks. So if you take a look at the small cap stock relative to the S&P 500, and this is, okay. So this was since May 19th. That was the inception date. That's when we created these two portfolios. So May 19th, let me go back over here and show you. If we start on May 19th, and then I go to solid line just to show you how this is performing. Anytime I do relative charts, I like using solid lines. I think the candlesticks are just kind of wonky. Let's go ahead, and I think that'll do. So this is what small caps have been doing relative to the S&P 500 since May 19th. We've had a couple of periods of strength, but for the most part, small caps are underperforming. And right now, we're at our low since May 19th. And I mean, we've come down quite a bit. If I show you mid caps versus the S&P 500, look at this. I mean, it's the same thing, just been a steady downtrend. So if you're picking small cap stocks and mid cap stocks for an aggressive fund and you're comparing it to the S&P 500, like I did here, it's pretty impressive that this group is outperforming the S&P 500 when the stocks are coming from areas of the market that are absolutely getting trounced by the S&P 500. So I would argue that that might be the most, the most impressive of all the portfolios. Income portfolio is pretty impressive because it's just name. It's the name brand. Let me show you income portfolio. We can go back into the prior quarter, starting in May. Accenture, Kansas City Southern, Kimberly-Clark, Hershey's, Waste Management, Colgate, Ingersoll Rand, L3 Technologies, Tyson Foods, Disney. You go into the next quarter, Coke, Lockheed Martin, Hershey's, Hershey's was a repeat. Starbucks, this is how they performed, by the way. OMF, that's One Main. Apple, LHX again, KLAC, KLA Corp, and Walmart. I mean, you're kind of getting an idea. These are big companies. The ones that are in there right now, PNC, Dover, Kansas City Southern's back, Microsoft, Intel, Apple's down here, Raytheon, Amgen, which didn't have a very good report this past week. MSCI did have a good report. Actually, the reports haven't been bad. Intel had a great report. Microsoft had a great report. PNC's report wasn't bad, but it just didn't matter. Banks have been getting hit with the 10-year Treasury yield dropping. But you can see this is going to be the least volatile because you've got big names. They all pay dividends. The average dividend right here in this portfolio, since we started, it's been close to 2%. So you got a little bit of income in addition to capital appreciation. Now, the one that we just started, and this one was a test and hasn't performed well, although I'm not giving up on it. I still think when we get into a market, these are all small and mid cap again, by the way. And the CC portfolio is the character change portfolio. So these companies were stocks that have been downtrending, but with their latest earnings reports, they gapped higher, and we put a basket of 10 of them together, thinking that a few of them would probably explode to the upside and maybe a couple would return to their underperforming ways and that it would outperform. Well, it hasn't helped that small caps and mid caps are underperforming by a wide margin. So this probably wouldn't look nearly as bad if I was comparing it to the small cap or the mid cap index instead of the S&P. But to be consistent, I was just comparing them all. But this, again, this is the first quarter. We still got another few weeks for the first quarter to be over. And I'm interested to see how this does maybe over the course of a year. But anyway, those are the portfolios. So you could come in here, for instance, we've got members who do use the portfolios in a lot of different ways. We basically hold them for 90 days through one earnings report. But members can do whatever they want. I've had members write to me and say, well, you know, I'm taking a couple out of each one. I just look at the ones I like. And that's fine, but just keep in mind that each one of these portfolios is equal weighted, 10 equal weighted stocks, and they're in 10 different industry groups. Now, I'm not looking to get into energy. Actually, there is one, I think might be in the character change. I think Murphy Oil is in there, but that's the only energy stock I believe that's in any of the four portfolios. And it's because energy has been an underperformer for a while. So it's not going to be, we're not going to have a whole lot of energy stocks on our strong earnings chart list because they just haven't been performing well. And their earnings haven't been very good. But I know Murphy was one. So, but the whole idea is that we've set it up to hold these portfolios for 90 days. But our members can do whatever they want with them. We buy them as of a certain day, talking about maybe changing the strategy there a little bit. And by the way, this portfolio, this is a webinar we do every quarter, which is coming up February 19th. So we do it the 19th every 3 months. So November 19th, February 19th, May 19th, August 19th. You can mark your calendar. But coming up on February 19th as part of, if you're a 30-day trial member, by the way, you pay the $7, get your money back. That'll be part of your membership, just being in here and getting the next 40 stocks that go into these 4 portfolios. So it really is a no-brainer. But anyhow, the strategy for us, I can't possibly know everybody's risk tolerance. I don't know, for instance, everybody in this room, are you more apt to want to be an income? You know, are you more, you know, if you're going to get in the stock market, would you be more comfortable with the big name companies that pay dividends? You know, and having 10 equal weighted stocks like that have shown historically, since we started this back in on May 19th, this group has not had nearly the drawdown that the other portfolios have. So for somebody who's a little bit more conservative, wants to participate in the market, but doesn't want to get crazy, the income portfolio makes sense. And when you're going with these bigger companies that pay dividends, I mean, we're only into our 3rd quarter, and we're already almost 5 percentage points above the S&P 500. I think that's pretty strong. I think any portfolio manager would love that. I think that speaks pretty well. So I think the 3 portfolios have been doing very well. The character change portfolio is new. We might try and tweak it. I'm going to try to figure out what works, what doesn't, and see if we can improve that portfolio going forward, the performance there. But anyway, this is another big part of our service that everybody needs to be aware of. All right, I am ready to go over the earnings. So I think, John, this would be a great opportunity before I show earnings predictions that I made last week and show you some of these results, which were crazy good, and then give you predictions for next week. I think I'll let John take over, and I'm going to take about a 60-second or a couple-minute break here.
Okay, Tom, thanks so much. Even though I'm part of the business here, obviously, with Tom Partners, I still learn something when he goes over everything, especially the new sharing at StockCharts. I can't begin to tell you how valuable that is to us and to you. We can do it now so much. Kudos to StockCharts, by the way, for working with us to help set this up. Just imagine us doing the work and sharing with you a list of companies, sometimes hundreds, that beat top and bottom line estimates. It would take you an awful lot of time. You have more valuable things to do with your time, so that's where we come in. In this next section that Tom's going to get involved in, I think you're going to be super impressed with this whole idea of trying to get a handle on how companies might perform once they release their earnings. So what I want to do real quick, and Tom's coming right back, just to remind you, this will be a minute, maybe. If you're not currently a member of Earnings Beats, just sign up for the no cost. You have to put your credit card information, pay $7, but you get the $7 back. Try us for a month. It's a great time to do it because we have the portfolio pick webinar coming up in just a couple of weeks. That alone is worth giving a shot, plus everything else we have to offer, and there's other goodies that we'll get as well. So really, if you haven't done it, just go to the site. It says our service, just sign up. And then if you want to save a lot of money, if you're an existing monthly member, or you want to just commit to us for the next year, you like what you see, you really save the greatest amount of money. So either of those is available by going to the site. This one, just go to the webinar special, and we're all set. That's it. I'm done. Tom, turning it back over to you.
Okay, sounds good. I do want to mention there were a couple questions that came up, or a couple comments. One was Amazon didn't really show this before, did it? And I guess that's when I was talking about Amazon gapping up. No, on the charts it really didn't. I did not expect that out of Amazon. In fact, I said, you know, essentially be prepared. You know, be cautious, be prepared for maybe a not so great report, because they obviously weren't letting the cat out of the bag with Wall Street. They were being extremely cautious, I guess, leading up to the end of their quarter. Once the quarter ends, they go into what's called a quiet period. So from the end of their quarter to when they release earnings, they can't talk to analysts, at least not supposed to. And so maybe, I mean, I can't believe Amazon beat the way they beat and they didn't know it. I mean, I just think they chose to be very cautious and not give out the information, which is fine. So yeah, on the charts, I would have never thought that they were going to come out and go up 200 points on the earnings. That's for sure. And then one other comment, don't forget to point out that only advanced members of StockCharts can save the list. I think I thought I mentioned it, but if I didn't, yeah, what is being referred to there is when you download the list, if I send you a link and you click on that link, if you're a member, it'll give you the options. If you're an extra member or above, it'll give you the options to download. Now, if you're a member and you're a basic member, I don't know what it'll do. I don't think you'll get the ads, but I guess you just won't get the option of downloading. I'm not sure how that shows up. Maybe if somebody out there is a basic member and you get this link early in the week, maybe you can just write in and tell us. I mean, you can write to me at Tom at earningsbeats.com. No B, just Tom at earningsbeats.com, or you can just write into support at earningsbeats.com, either way, and we'll get that information. But I'd love to know, if you're a basic member and you try to download, what does it let you do? I think what you're probably going to be able to do, you're probably not going to be able to download the chart list, but I think what you might be able to do is when you click on each individual chart, because you do have one chart list, you might be able to download it into that chart list. But you would have to do it one at a time, which, you know, again, if there are 300 charts on there, that probably would be worth its weight in gold just to go ahead and up your membership. So you didn't have to do that. All right. Oh, I see some member or somebody in the audience saying sold Amazon on Tuesday. Yeah, that's what I would do for sure. And then, you know, something that comes out, you know, that gaps up or gaps down, be the one I hold. That's my luck. But anyway, let's go ahead and take a look at some of these results. And I'm going to share a spreadsheet with you. And as I've always said, I have never met a spreadsheet that I didn't like. Why isn't that showing up? Oh, never mind. I'm not sharing my screen. That's why. All right, hold on a second. All right, and John, I just want you to let me know when I share if you can see this spreadsheet. All right, can you see it, John?
Yes.
All right, perfect. Okay, so what I did last week, and this is something that continues to evolve here at Earnings Beats. I mean, I'm kind of excited about this, and I'm just doing a lot more studies on it. And those of you who are maybe a little bit more on the edge and are more gamblers and like to take shots on stocks heading into earnings, that's not been something that I've really done because I've never really done a lot of studying of it in terms of looking at relative strength and looking at volume trends and looking at the industry groups that they're in and so forth. But as I do more and more of this, I'm starting to see some clear positive correlations between how these stocks look leading up to earnings and how they report in terms of revenues and earnings per share. And so what I did was a week ago, we had a webinar here at Earnings Beats. It was Q4 earnings. And what I ended up doing was providing a number of stocks that I thought looked really good heading into their earnings reports last week. And then down here at the bottom, I gave out 8 stocks that I didn't like, that were, on a relative basis, not performing well. Maybe volume trends were poor. Maybe their industry group was really bad and they were pretty bad to go with it. But whatever. When I started looking at the results, because I didn't pay much attention to this again until Wednesday or Thursday, I started putting this together and I actually wrote an article. You can go back, I think it was in my Trading Places blog on Thursday, where I was recapping some of the information. I'll go over some of it here. But essentially what I did is I went back and all the stocks that I said looked bullish, that if I was going to make it, if I had to hold or into earnings or sell into earnings, these are the ones I decided I would hold into earnings. And you can see the list. I've got them all grouped here from DHI all the way down here to the bottom at CHTR, which came out on Friday and had a blowout report. And what I did is I went back and I saw, okay, where did the stock close the day, right before it reported earnings? So if it was reporting Monday after the close, then I took Monday's close. If they were reporting Tuesday before the open, I took Monday's close. But if they were reporting Tuesday after the close, then I took Tuesday's close. The whole idea was the close before they came out with their announcement. And then I went in and looked to see where it opened, when it opened the next day. First open after earnings. And then I calculated their gap, up or down. Green is obviously higher, red is lower. And I have on here revenues, actual versus estimate, EPS, actual versus estimate. Now, the first thing I noticed is when you go down this list, and there were 44 stocks here, look at how many were red in terms of earnings per share missing. I counted 3. FICO, Fair Isaac, Allegiant, ALGT, and ARNC. Those were the 3. That's out of 44. So 41 matched or beat. And when I looked, there were only 3. The ones here in black met estimates. So there were 3 of those. So ROK, EGOV, and LLNW. So 38 beat earnings estimates, 3 matched, and 3 missed. That's a pretty strong correlation when I'm looking to see how these stocks, I like the way they're trading. I like the relative strength. I like maybe the groups that they're in. Whatever it was, I like the chart. That's pretty strong revenue, or excuse me, earnings per share beating. Hold on one second. Let me get some water. All right, I'm going to go in, and if you've got another screen up, you can go into StockCharts. I'm just going to go into the articles, and I'm going to read you summaries of what I found on Thursday. I mean, that pretty much is the same thing now. But there were, I think when I wrote it on Thursday, there were still like 5 more companies that were going to be reporting Thursday night. So I had to update it for that. So now that's been updated. But let me go in and take a look at this article. Again, that was in Trading Places. Yeah, Thursday I wrote it. So, and the title of it was Want to Better Predict Earnings Results Before They're Released? Check this out. So go back and if you haven't already read that article, check it out. But I've got basically this spreadsheet that you're looking at here. I took a screenshot and then I just inserted it into my article. But the only difference is when you get to the bottom here, you'll see probably about 5 that were added that reported after the market closed on Thursday. So FICO was the one that missed. And then the others would have reported 1:30, January 30 AMC, or January 31st before the market opened. There was just one of those. But there looked like I think there's 5. So VRTX was one. They beat across the board. RMD beat top line and bottom line. FICO beat top line, missed bottom line. Flextronics beat top line, beat bottom line. And then Charter beat top line, beat bottom line. And remember, all of these were given out to our members last week in advance. So I didn't know how any of these companies were going to report, but I wanted to see the correlation between how they were trading on a relative basis and on an absolute basis and how they ended up reporting. So here I summarized the results in the article. Now, this only included 39 of the companies at that point. 30 out of 39 beat revenue, and 34 out of 39 beat earnings per share. And now that number is, well, all 5 beat revenue. So now the number is 35 out of 44. So 35 times out of 44, there's probably only 9. If we go down this list, there should only be 9 revenues that are in red. 4, 5, 6, 7, 8, 9. Yep. So 35 out of 44 of the companies beat revenue estimates, and 38 out of 44 beat earnings estimates. And the more important thing is how they gapped up. Now, I think 26 ended up gapping up. So as of the article on Thursday, 23 had gapped up out of 39. Now it's 26 out of 44. The gains of the 26 that gapped higher, this was the average gap to the upside, 4.2. Of the 18 that gapped lower, the average was minus 2.31. So then I said, well, what if, you know, based on this, what if we had $10,000? Now it could be 1,000, it could be whatever. Percentage will be the same. But what if I had $10,000 and it got invested in each one of these stocks literally right at the close before earnings came out, and you sold at the opening bell? What would have happened? And these would have been the individual winners and losers, and the total would have been $6,755. And then the losers, you're shorting. So you're actually selling first, and then you're buying back at the lower price. So when they gap down, you're making money. So these minuses, it gaps down, but you're shorting. So that's profit, 765. And profit. Only one of them actually gapped up, one of the 8. Boeing. And I think just because it had been beaten up so much that I think there might have just been a relief rally that Boeing didn't post any worse numbers. Although when you look at these numbers, my gosh, I don't know what they were expecting. The revenues came up way short. Earnings per share is horrible. Yeah, it just was an awful report. But still, it gapped up. I'm not a fan of Boeing at this point. I think it's got a lot of work to do. But look at the other 7. And when you look at these 7, and I summarized these in that article as well, beating revenues. So remember, 38 out of 44 beat revenues. That's not far from being 90%. Down here on revenues, well, I was doing earnings, never mind. So 35 out of 44. So what would that be? I don't know, probably close to 80%, 70-something percent. It's 36 out of 45 would be 80. So 34, so it's just under 80% revenues beat. The ones that didn't look good, only 37%, 3 out of 8 revenues beat. And then we go to earnings, 38 out of 44. So that's going to be, I don't know, probably 87% of earnings beat. And then you come down here and only 2 out of 8, 25% beat. So I'm starting to see some pretty significant correlations here between, and if you think about it, why are these companies trending higher relative to the S&P 500 or why are they trending lower versus the S&P 500? Remember, Wall Street goes out, analysts go out and they meet with these companies and they find out what's going on. And if management's honest with them, they come out of those meetings and they're deciding whether to buy or sell. So, yeah, I mean, if you've got Applied Materials and KLA Corp, and you meet with both those companies and Applied Materials says, wow, we're going gangbusters. We can't keep up with demand. Our numbers are looking really strong. We're tracking great this quarter. And then you go over to KLA and they're like, well, yeah, we've kind of experienced a little bit of a slowdown. You know, you walk away from those two meetings, I'm going to buy Applied Materials and I'm going to sell KLA. And so that begins to get translated onto these charts before their earnings come out. And that's why I think it's really important to follow this. And as I said, this is a service, or part of our service, that I think is really evolving. We've got our Earnings Beats Digest, which goes out 3 times a week, Monday, Wednesday, Friday, and it deals with earnings and relative strength, really just to get everybody up to speed. It's a very educational, very brief article. I mean, don't think I'm sending you like this huge article is going to take you 20 minutes to read. Normally you can open it up, click through it, and you're done in probably 3 to 5 minutes at most, even after looking at the chart. So it's just very brief, quick little paragraph, a chart, another quick little paragraph. And of course, that's our free newsletter. So with a free newsletter, as with any free newsletter, you're going to have some marketing stuff because we'd love for you to join us. And then, by the way, I believe, yes, here on our website, you can't see it because I don't have the website up right now, but where I showed you portfolios and where our member section is on our website, there's an Earnings Beats Digest where you can go in there and get the information. And I'm just looking to see, because, yeah, you can just go right in and get all of the information and ignore the ads. I'm looking to see. Well, there still is a little blurb there. Actually, that's just for a webinar, though, which I don't think that the information's the same. I don't know, maybe John could tell you a little bit more about that. But anyhow, so that is it for the earnings predictions from last week. So now I'm going to end this, and we're not ready to end, believe me. But I'm going to end it by going over some stocks. And I think what I'll do is, you can see on the screen here, these are all the stocks that I'm looking ahead and saying they look good. So these, starting with Google and working our way all the way down to PBH, those are stocks that I am pretty comfortable with, that I think are going to be among those that report stronger than expected results. And then starting with Checkpoint Software, CHKP, and going all the way down here to, I'm not sure, New Park Resources, I think, NR. Those are ones that I don't like. And there's a lot more of those this upcoming week, by the way. I think I have 50 on the bullish side and 40 on the bearish side. Now, let me go ahead and take this back down. And let's go back up here. I'll show you this. And so now I've got these chart lists, these 2 chart lists, bullish Q4 earnings predictions and bearish Q4 earnings predictions. And again, another water break here. Again, I just want to remind you, anybody who signs up even for a trial, a $7 trial, which you get refunded, I'll send you not only the Strong Earnings chart list, but I'll also send you this chart list for bullish Q4 earnings and the chart list for the bearish Q4 earnings predictions. So you'll have those. And the beauty is, again, you can pull these up like the bullish. This is the bullish. I can view all. And on Monday, the ones that are in, at the beginning, these are all sequenced, by the way, in terms of date order this week. So the first few here are going to be, I'm going to try to give you an idea. So for instance, ACM on, so these first two both report in the morning on Monday. So those are going to be the first two that you're going to see impacted. Charts 3 through 7 are reporting after the close on Monday. And then this starting with Aqua, and you can, what I have it sorted in, I have it sorted twice. First by date, and then second by, actually I have it sorted 3 ways. First by date, second by either morning or afternoon, and then third by alphabetical. So when you see this A and O, that's telling you morning, Monday. Then you go, all of a sudden go back to F. That means it's the next, which would be after the close on Monday. And then that goes down here to S. And then you start again at A. That's going to be Tuesday morning. And that goes down to TDG. And then it starts over again here. So that's going to be Tuesday afternoon with Allstate. And so forth. So just to give you some sense. So in other words, when you do this summary, and if you click on name, it'll show you, you'll probably see first thing Monday morning, these two, I imagine, are going to get some kind of a big move one way or the other. That's just usually what happens with earnings. And I'm suggesting that they're going to go higher. It'd be interesting because I'm going to go back and I'm going to do the analysis, whether I'm right or wrong, whether it turns out to support what we did last week or whether it goes opposite. I will be calculating. I mean, I want to know. And the ones that don't work, I'm going to go back and take a look. Maybe I started including too many. Maybe a lot of them that failed looked good themselves, but maybe their industry group was bad. But I'm going to keep working on this and refining this to try to get our members some of the best probable gap ups with earnings, or gap downs, if you like to short. And again, I always say probable. There's no guarantee. I did make a guarantee last week in Chart Watchers. I said two companies I was going to guarantee how they were going to do with earnings. I guaranteed Apple was going higher and it was going to beat top and bottom line. And I guaranteed that 3M was going to go lower and it was going to miss top and bottom line. And they all came true. And it was based on the just the relative strength, just doing the analysis. So, but we'll see. We'll see how they do. But taking a look at these, and I'm not going to, I mean, my gosh, there's 50 of them. Like I said, I'll send you the list. You can look at them and take a look at the ones that you really like. I'm going to try to go through some of these and give you ones that I think, I'm not going to say are no-brainers, but certainly are ones that I really like going into the earnings. One is TransDigm. If you look at this chart, I mean, this thing has been straight up. The things that are going to melt up in a market like this are companies that are going to provide solid earnings growth, or earnings growth is even getting stronger. And when I look at this move to the upside, it's not just the move, but look down here at the volume. I mean, here was probably about 7 straight trading days around 400,000 shares or more. And when you look back, 400,000 has been pretty good volume on this stock. I mean, yeah, with earnings, maybe here you get a little over 1 million. But 400, 500,000 is pretty good days volume, and we were getting them over and over again during this. So I think there's a lot of accumulation. That kind of reeks to me that Wall Street's been out there and they like what they're hearing and they're accumulating. Now, one thing you have to be careful of, and we saw this a lot last week, is that companies, I might think they're going to be great, and they do come out great, and then they get a great reaction, and then the selling kicks in. And I'll give you a couple of examples here. Look at Corvo. This was one I really liked last week going into earnings. They came out, they beat top line, they beat bottom line. The stock was up, I think it was up like $13 on Wednesday evening after the bell. It was up to like 126 at one point. It opened at 121 and change, 121.61 from the prior day's close at 112.57. So it was up $9 at the open. So if you had your market order in, you got out. And look what happened afterwards. And I've seen this on so many, especially on the semiconductors, because a lot of it was built in. Buy on rumor, sell on news. Probably heard it before. It happens a lot in the market. And so buying a company and just holding it through its earnings report and just deciding to keep holding it, maybe isn't the best idea. And there's two reasons for that. Number one, it could be the buy on rumor, sell on news. But the second thing is when everybody wants to buy, if you understand how the market works, everybody jumps in, wants to buy. Guess who's on the other side of the trade? Market makers. Market makers are shorting. And if you've ever listened to a market maker go through a conference call, I'll never forget listening to Lloyd Blankstein, what was his name? Goldman Sachs, back in 2010, right after the huge bear market. And I remember him being on the Charlie Rose show. And you probably can Google it, YouTube it or something, search it. But man, he was gloating as to how much money they had made in their market making unit. And I'm thinking, really, after the last 3 years market, so many people losing a fortune in the market, you're going to come on here and talk about how much money, and already everybody was, fuming about Goldman Sachs and a lot of these other companies benefiting from the subprime market, telling everybody else to buy while they're shorting. And then the whole market making group is just kind of like this black cloud, but you have to be aware of it when you're trading. You have to know how it works. So when everybody wants to buy at the open, market makers are on the other side. Now, sometimes the demand is so great that market makers can't get control of the action. They end up having to just cover. I'm assuming that's what they do. But most of the time, many times you get the gap up and then you see the huge drop off after earnings. And so what happens is market makers short, and I've never worked for one. So when I say this is what happens, this is what I think happens. Market makers gap up, or stocks gap up, market makers short, everybody else in the public's getting excited. Corvo, another one was Teradyne. Teradyne came out with an awesome report. One of the best reports of the entire earnings season so far. Look at this. It was going up into earnings, got the gap up. Look at that black candle print, and look at what has happened here since. Now, I don't know what's going to happen. This stock opened up. It went from 73 and change to 79, 79.05. And now here it is. 6 trading days later, it's 65.99. Now, anybody buying that was chasing at 79 or 80 or 81 even, the high was 81.57. Imagine what they're thinking 5 days later when the stock is at 65, if they're still even holding. I mean, you'd be panicking out of your stock. What's going on? I don't understand. So you sell. Well, guess what happens? Market maker, which was shorting, you're now selling, they're buying, they're covering through this process. So if they're shorting up at the top, they're making money all the way down. And then when you're ready to sell, they're going to start buying. And guess what's probably going to happen at some point? It's going to turn right back to the upside. Here, I mean, we had one day of buying, but look what happened here. Came back down quite a bit and then turned right back up, started moving higher. That's the way the market works. I don't know what else to say. So Teradyne is something, definitely one to keep an eye on. I think we'll do well. Corvo, same thing, but we've got to figure out how to carve out a bottom. So getting back to TDG, I think we're going to have a blowout quarter. I think the revenues are going to beat by a mile. I think earnings are going to explode, and we might see the gap up. After that, I couldn't tell you what's going to happen. I think it really is a coin toss, because I just don't know how much demand is going to be there. I do know market makers are going to short if it's a gap up. So you've always got to be prepared for that pullback. I would just be, somewhat cautious after an open. So again, that's why, hey, John, I don't know if you can take over for 1 minute. If you're there, John.
I am here.
Hold on 1 second. I've got to step away. It'll literally be 20 seconds.
Okay, sure. Yep. I'll tell you one thing, I'm taking notes here, especially on the ones that Tom thinks, could explode high. One thing I have done with some success, I'm not saying that this is for everybody, by the way, but of course with the free commissions especially, you can just make more moves than you ever could in the past. There's an aftermarket. You've got to study this. And again, I'm not recommending this for everybody at all, but I've had some success. Tom was showing a stock that gapped up 13, 14%. Um, I've had some success, particularly when I see these stocks that are going up to, that are already overbought. They're already overbought going into the earnings report. They gap up, to a level that's either a key resistance level or they're just so stretched it's unbelievable. I've had some success in aftermarket putting in if I own the stock, uh, in actually taking profits off the table, right then. So let's say I owned a stock and it was $100 and went to $125. I have had good success after hours in just putting in a limit order up near the price that it's said, maybe a little bit less to make sure it executes. Maybe I hold part of the position, maybe not, because of exactly what Tom's talking about. These things explode to the upside, and by the next day, they're down dramatically. So it's pretty. I'm sure every single broker has after-hours trading ability. You have to designate that as an after-hours trade, and you have to it can't be a market order. It's got to be a limit order that you put in there. That's one potential way to preserve, some really big profits. Anyways, that's for another day, but something worth considering.
Okay. Yeah, I agree. And actually, market maker participation in after hours is voluntary. So that's why a lot of times in after hours, you get a stock and it'll trade, one trade will be, like John said, 123, and the next trade's 125.75, and the next trade's 124.50. That's what would happen if we didn't have a market maker system. I mean, it would just be whoever wants, if an order matches, it goes off. If it doesn't, you just sit there. I mean, now we're kind of spoiled with market makers, because if we want to get out, we can get out. We can just say, hey, put a market order in and it will sell. And generally, unless you're in a really illiquid stock, you're going to get pretty darn close to the market price. But yeah, so sometimes you definitely can take advantage. I've had that question before, do I ever trade after hours? And I say only if it benefits me. So if it's going in my direction, then yes. If it's going against me, I generally don't, because again, I'm probably going to get whipsawed by the lack of liquidity. All right, so let's jump back in here. And I wanted to just go over a few of these stocks. So TDG was one that definitely to me looks like it's going to be a very strong stock. Another one on the list is PCTY, Paylocity. Here's another one making a big move. And the thing is that I really like here is, if you look down here, it's part of software. We know how strong software is. Well, look at PCTY relative to software. So we got a great group, and now we've got one of the best stocks in the group. Why would this stock be outperforming all the other great software stocks unless Wall Street liked what it was hearing, and leading up to the end of the quarter, it was buying the stock? So I'll be shocked if PCTY doesn't beat on top and bottom line. Now, again, does it mean that we're going to gap higher? No, I think that the odds are not as great. I think the odds are really good it's going to report strong numbers. I think the odds of gapping higher are probably a little less. I think I still would expect it to gap higher, as the study from last week showed. I think it was 26 out of 44 gapped higher, even though 38 out of 44 beat earnings expectations. So I think the odds are still in your favor. But there clearly are no guarantees. I don't care how a stock's performing. There's no way of knowing whether or not a stock is going to gap up or gap down. So I wouldn't go there. But I do think that if I had my 40 favorite stocks throughout the entire earnings season, and I played all 40 stocks that were really looking strong, like PCTY does, or like some of the semiconductors looked last week, I got to believe that over the course of 40 trades, I would make some pretty good money trading into earnings. And that's what I'm finding out by using the relative strength, and why I'm spending so much time now doing these webinars and tracking these, because I want to test it. I don't want to just say, oh, well, 3 out of 4 worked last week, so I'm just going to throw my money in this week. Well, that would probably be the time that 3 out of 4 didn't work, or 9 out of 10. Based on my luck. But I do think that it's important to follow relative strength. I think if I was going to make my decision on whether to hold a stock into earnings or not, it would come down to the industry group. I'd be much more comfortable right now holding semiconductor stocks, holding computer hardware stocks, especially Apple, which was just off the charts, or software, or some of these other areas that have been really strong. Let's see, another one that looks strong. And again, these are in chart lists, so I will send these out to all of our members, including trial members. Maybe I'll put that in the daily market report on Monday so that you'll have the links to all of these different things, including portfolios too, by the way. Of course, if you're a member, you can go in and you can look at the portfolios, but if I send them to you, you can just have it and download it into your account. Let's see, another one. Let's look at Nuance. This is N-U-A-N. Look at the move. Look at the volume coming in. So that's the thing. I talked to some technicians that I have a tremendous amount of respect for, and they tell me they don't pay attention to volume. I just don't understand. I don't get that. How can you possibly have Wall Street accumulation, institutional accumulation, without volume? If I get a stock that's breaking out and there's no volume, it's certainly not telling me that Wall Street's jumping in on it. I mean, this doesn't guarantee me that Wall Street's jumping in on it, but it certainly helps the argument. It's possible that there's a lot of folks jumping in here that are institutions. Now, I look at this and I say, wow, it's coming down relative to software over the last couple of weeks. Well, remember, number one, the volume's lighter. And remember, this is a quiet period right now. So it's not like Wall Street is getting information and coming in and selling. What I'm more impressed about is that the stock hit a 52-week relative high, or almost a 52-week relative high, here in the month of December, or in January. And here in December, we were at a 10 or 11-month high. So volume's coming in. It's trending higher relative to a very, very strong group. I got to believe there's a reason for it. And so this is a stock that's now pulled back. Could this gap up and break back up above $20? Let me show you one last week that did that. And then, of course, it sold off right afterwards, MTSI. Look at the stock moving up. Go down here, the relative strength. See the relative, here's the group, semiconductors. Relative strength was at a 52-week high. Right before earnings, it came down 3 days in a row. And we saw the relative pullback. And then look what happened with earnings. It gaps up above that prior high. Now, it came back down. Of course, everything in the market was coming down. But the strategy, if you looked at it and you said, yeah, I want to hold this one into earnings, there you go, 26 and change to 30 and change. I don't know, 10%, 12%. Pretty nice gap up on the stock. So, there's definitely some merit to it. It's just a matter of how much risk you're willing to take. If you're on fixed income or you're retired, you really can't take chances, then I would probably stop the recording. I'd leave the room right now. This probably isn't helping you any. But if you're somebody that likes to take some chances with the opportunity of maybe catching that quick 8, 10, 20% pop with earnings that we get sometimes. I mean, look at Tesla. What was it, up 47, 57, maybe $67 right out of the gate with its earnings? And you think, well, it's already gone up so much. Well, it has, but what that's telling me is it's going to have a big report, and there it was. So it gapped from 580 at the close to 632. So it was up $52 on a 580 investment. So what's that, 94%, 9.4%, 9.3%, something like that. All right. So Nuance was one. How about Synaptics? This is one that comes out later in the week. I said if there was one other computer hardware stock that looks to me like it's going to come out with big numbers, it's Synaptic. And look at the volume coming back down here. Last 5 or 6 days, pulling back. Stock was at 75 and change. Now it's at 66. And if they're going to come out with big numbers, we could see the big gap up here. Nice relative strength, been moving up versus computer hardware. And it's not easy to move up relative to computer hardware because Apple is primarily computer hardware and Apple has been flying. So to outperform the computer hardware group, you have to really be doing something. Look at the volume coming in on these moves. So something's going on with Synaptics. I wouldn't be surprised to see a big blowout quarter there. All right, now as far as some of the weaker stocks, so we just maybe have another 5 minutes or so and then we'll wrap this thing up. But as far as some of the weaker stocks go, let's see here. One, this one I wasn't quite sure what to do with. This one could have a big gap down. Grubhub. It's been under a lot of pressure. I mean, you could make an argument that's an exhaustive gap and now it's in an uptrend. But even though it's been an uptrend, I mean, the overall restaurant group's been going up. This one hasn't, Grubhub hasn't even gotten back to where it was on a relative basis prior to the gap down. So, but it does have a little bit of, volume coming in, but there's gap resistance and all it's done is go up to gap resistance and now start to roll over. I wouldn't be surprised to see another big gap down on the stock. I don't know. Maybe it's more of a gut feeling than anything, but it does have, relative to the restaurant group over the last year, it's been moving lower. Relative to the S&P has been moving lower. And even the group overall has not been very strong. So while I love a company like Chipotle, which has been a leader in the space, I am not a fan of Grubhub. I think this is one that it gets hit. We'll see. All right, let's look at, well, I talked about autos and Tesla. Take a look at GM. GM reports this week, and here's the stock on an absolute basis, down near a 52-week low. Here it is. Here's autos moving up, but mostly because of Tesla. Look at GM relative to autos. Absolutely getting crushed. So, and versus the S&P 500. So even though autos are exploding higher versus the S&P, GM keeps drifting lower and lower. And Ford, to be honest, isn't any better. Ford reports this week as well. I mean, you look at this chart, you're seeing basically the same thing. Very, very poor relative performance. So both of those are on the list. I'll be surprised if they perform well. How about PTEN? Patterson UTI, been downtrending here. We almost got to that high, couldn't get through. And now here we are. We did print a little hammer here in the short term. This one reports later in the week. It reports on Thursday before the market opens. But this looks like a triple bottom, and I just have a feeling, look at the relative strength. First of all, look at the group. So the group has just gone to a new 52-week low. It's in the energy area. It's gone to a new 52-week low versus the S&P, and this stock is at a 52-week low relative to its peers. So you got one of the worst stocks in one of the worst industry groups. That, to me, I mean, if they came out with blowout earnings, they're going to shock Wall Street. They're going to shock me. They're going to shock a lot of folks. I think we're going to see another gap down. Let's get a couple more here. How about MSGN? This is MSG Networks. Stock has been going down. You can see the huge gap down there. Here, start to go back down, lots of volume, get a little bit of a rebound, and now we're moving back down below these prior lows. I don't know, rolling over. It's in recreational services, which right now, 52-week low versus the S&P. The recreational services just moved to a new 52-week low there. And then you got the stock down near 52-week low recently versus its peers. So I don't know. It's just looking to me like it's setting up for another drop. I wouldn't be surprised to see maybe a gap down below this prior low. We'll see. And let's try one more. Trying to find one that's in a good space, but it's just a bad looking stock, because those are ones that, you're really not quite sure what to do with. I mean, if you got a really good group, industry group, Checkpoint's out on Monday. Maybe let's look at Checkpoint, CHKP. This is one on my list. So here you've got software that's just been going crazy over the last 3 months. And you've got Checkpoint, which has gone up a little bit, but nowhere near what the group has done. So on a relative basis, this thing has just been going down, down, down. It's at a 52-week relative low. Now, software has been moving up versus the S&P 500, so you got a really good group. And despite the fact software has been crushing the S&P 500, Checkpoint, a software company, has been trailing the S&P 500, just keeps moving lower and lower. That is, in a nutshell, Wall Street looking at various software companies and saying, I love this company, but I don't like CHKP. And that makes me want to stay away from the stock. If I did anything, again, it would be a short. If I had to take a position, I'd have to short it based on what I'm seeing. But as we go through all these results, that's one thing that I'm going to look at. You know, is it different when you have a really bad stock, but it's in a good industry? Is that where we get most of our curveballs and we make most of our mistakes? Or are they still just as likely to go down? But that'll be interesting. Anyway, that is essentially what I wanted to go over. So I've got 50 stocks on this bullish Q4 earnings predictions. I can tell you how many I have. I've got 47. And on the bearish one, I've got 40. So that's a total of 87 stocks. I mean, I went through all the earnings coming up. I went through Thursday. I don't think I did Friday. Of course, Friday doesn't have any after the hours. So it would have only been Friday morning. And usually there's not as many earnings reports on Friday. So, and it also gives me a little bit of time maybe on Friday to look at the results and try to get those available to our members. Or maybe I'll publish it in one of blog articles or something. We'll see. But anyway, hopefully this has been a really good webinar for you. I'd love to get feedback. If you want to send me a note, you can send me a note at tom@earningsbeats.com. Let me know what you think of this sharing the chart list feature. I think this is so big for our business. Makes it so much easier. I can just literally put a link in an email and it goes out to everybody, as opposed to Erin, my daughter, having to sit there and type in everybody's, well, not type in, she copies and pastes, but you know what I'm saying, individually sending these out. I mean, that was crazy. But this is much better. So hopefully, that's better for everybody. It'll also make it a lot easier for us to send multiple chart lists. We've had people asking us in the past, would you mind sending me that chart list? Well, in the past, it was hard because we had to do it one at a time. Now we can send the link to everybody and you just download it into your account. So we can do a lot more of that. We can update the Strong Earnings chart list much more often if we want, because again, all I do is send you a link with a new password and you can download the new one right into your account. I showed you how fast you can do it. Literally from the time you receive it, once you, figure out exactly what you're doing, it's not that difficult. But literally you can do it in 10 seconds or less. An entire chart list has been rewritten into your account, which I just think is amazing. But I'd love to hear back, get some feedback, what you think of that or what you think of my take on the market. I don't care, whatever. I'd just love to get feedback. So for those of you, again, who are new to Earnings Beats, we'd love to have you come on board as a trial member, $7 trial, 30 days, and we'll refund you the $7. I mean, we're doing everything we can to get you in to try our service. If it's not for you, I completely understand. I think we have something for those of you who are short-term oriented. I think some of you that are longer term will find some of our portfolios interesting. So hopefully you'll be amenable to giving us a shot and trying our service out. Again, John laid out that annual. If you really like what you see and you think you'd like to be a long-term member, you're going to save, 40, 45% on the monthly amount if you were here for a year versus the annual. And once you're an annual, you get that industry group chart list that John referred to earlier.
Awesome, Tom. Great job. We'll make sure everybody, that this recording is posted by Monday morning. Anything that, Tom talked about to be sent out to everybody will be sent out. And anybody who, even if you're a trial member, you'll get access to these predictions as well. So great job.
You know where I'm going now, John.
Have one for me, would you?
Well, I'm going to do that, but that's after I go putt. I got to go practice my putting. It's 50 degrees.
Great job.
All right.
Thanks, everybody.
Yep. Have a great weekend, everybody, and thanks for coming.